Good afternoon, everyone. This is Henry Gambell with SimplerTrading.com, and in tonight's free video, I wanted to pick up with the analysis that I gave you last week. I think there were some helpful little pieces of information inside that video, and then give you another one that you can take into next week as we continue to build on hopefully some very helpful themes inside these free videos. So the one that we're going to start with here is the idea of looking at the market and the put-call ratio just from a year-to-date point of view. Now these charts have 1 year worth of daily data, but for now let's disregard these extreme readings in the put-call and just focus on where we began here at the beginning of the year. So if that's where we mark our time and begin analyzing this forward, you can see that when this put-call ratio spikes, it tends to be an area that helps mark a low in the markets, right? Because it's the idea that market participants are finally participating to the downside, or there's more fear in the market, and then when everybody comes in, it is all working one side of a trade, well then it just makes it harder to see that side come through. So the levels that I was giving you last week was to tell you to come in and look at anytime we get above, let the markets sell off until the put-call ratio can exceed this previous swing high. And then you'll know, all right, market participants are more bearish than they have been all year long. All throughout 2021, that reading has never been that extreme. So the idea that when you make that high, it will actually end up being support in equities because there's just too many people that are focused on the bearish side. So far, you can see that that's played out very well, right? You had the selling this morning that finally triggered that level, and then we've rallied from there. So it's just one piece of information that can help you not get short at the wrong time, or think about helpful ways of predicting bottoms in equities. So that was one from last week, and then what I'm going to have you take into next week, some pretty fancy illustrations here, but let's say today is Thursday. We have tomorrow, that of course will be Friday, then you get into the weekend, and next week will be an abbreviated week. So next week on Friday is Good Friday, and the markets will be closed. All right, on that Thursday, you have a historical tendency, or I should say a historical data, that shows that 19 out of 20 instances over the past 20 years, that day has been up 19 of those days. So while this is no holy grail, this type of data I think can be helpful in predictions. So this is what we use to help find the low for equities today. As you get into next week, just think if we are selling off into Wednesday afternoon, I think that could be a buying opportunity, looking for that positive Thursday, and then you head into Friday with a generally optimistic tone for that Good Friday. Now, it's just a way of thinking. You'll want to see it all kind of play out in that way to take advantage of it, but I think that's a great statistic that may help give you a little bit more of an edge as you get into your trading next week. So you'll have a good Friday and a great weekend, and we'll pick up on these ideas next Thursday.
Without simpler trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency. It's one of the things that won me